Good evening to all of you. Welcome you to today's webinar. Today we are going to look at very simple strategy for trading. This we are just going to use bar charts and gaps to find out the strategy for intraday trading. We can use this in index. We can also use it in commodities. But only thing is the time frame can slightly change. So what we are going to do is that we are going to have normally the Dow theory. Then we are also going to look at gaps and also simple if you have some 3 bars cut or a couple of bars cut, then you can go long and then go short against a cut of 3 bars or like that. So we are going to look at simple strategies. But before that, we will just look at what happened today in today's market. Today we saw a big fall after 2 o'clock. So this is the 2 o'clock 9:15 trade. First it went up and then came down, but subsequently if you see, I think this will be more clear in a 5 minutes chart. So if you look all within an hour or so. So this is being suit with the other global central banks, and this was a supply on interest rate hike. So today 40 basis point increase in interest rate spooked the market. Nifty fell, Bank Nifty seeing a very sideways market locked between 16.9 and 17.3. 3,400 could be a little difficult to penetrate. 17.4. So that we continue. Start. So we were highlighting the extent of fall that can take place within this month. So 2 sessions before, we had commented that chances of 16.4 to 16.2 is highly likely, and in Bank Nifty also said that there's a good chance that there can be more than 2,000 or even 3,000 points of fall that can take place from that particular week. So it is now in progress, and we have already seen closer to 16,600 levels, which is one important support, and break of that can take it right up to 16.4. So before we go into today's illustration, we will just look at the bigger time frame, and we will look at the weekly time frame first. And this is the fall that's now taking. So market can go right up to 16.4, and if it is going to be 16.4, then probably we could see the market range between 16.4 to 16, because this time also right now the top end of the range could be 17.2 because it has broken 16.824. The top end of the range could be 17.2 and the bottom end of the range could be 16.4 right now. So this is the big time frame analysis as far as the Nifty is concerned. Now we will look at the as I told you, we will look at a smaller time frame, but before that we also look at the Bank Nifty. Bank Nifty sorry. So this is Bank Nifty weekly option, weekly chart. The bigger one you can see. So we will put a Fibonacci for this. So here we see a 34,689, then probably we could see something like 33,594 or this particular low 34,000. So very good chance that we could be heading towards a 34,000 as far as the Bank Nifty is concerned. This is a very important weekly support before. So we could be looking towards a 34,000 support level right now. And since it has broken this particular Fibonacci, I think this high, which is 36,309, will be in place for time to come. So an intermediate top has been made at 36,309, and looks like as if we were heading towards 34,000 as far as Bank Nifty is concerned. So this is the big picture analysis as far as the Nifty and Bank Nifty is concerned. So now we will look at the smaller time frame, that is for intraday trading. We'll go to the Nifty first, and we will look at the so let us say we'll look at 1 hour chart. Now and even before also generally gaps are a big possibility in the Indian market, mainly because we are cut off from the global market for a considerable period of time. So we close at 3:30, and after that Europe is still open, then US time, US markets, then we have the Asian markets also open before us. So considerable global development and economic data releases take place during this particular time. And because of that, most of the time we have a reaction which is on the opposite side or which is along with the trend. Either one of this happens. So the overnight trade looks to be a little risky as far as Nifty is concerned. But at the same time, the big trend that you get, the big profit that you get, also you get in the overnight, because after a decent movement, after one jerky movement in the early part of the day in Indian market, maybe between 9:15 and 9:30 or 9:15 and 10, then you see an opposite reaction happening. Then after that, it just consolidates. So there is a lot of clustered activity or sideways movement during the major part of the Indian time. So when we look at the smaller time frame, mostly you trade on a trend basis. You just you will end up at a loss. And most of the time you can end up at a loss, unless you have a big developing trend, which is like what has happened today. So the general consensus is that to have a overnight position, if it works well for you, then you have very good profits overnight. Okay, so sometimes you have gap up, sometimes you gap down. So if you're along with the trend, then there's a good chance that you may make money. But in the period which is there in the morning time to almost 2:15 time, you generally have a very sideways motion. So if you can club any strategy which can have a trend as well as a non-trend system also built in it, then it will work out very well. So during the major part of the day, it may look as if it is better to go for some sort of a non-trending strategy. So probably you can buy and dip, sell on rally. These things can happen, but you'll always be nervous, because today, if you look at today's development, till today, for last couple of days, if you had followed a trending system, you would have made a loss. So put together, we have to see to what extent the rally or the fall takes place, and how much of patience we have in riding with the trend. So the most important thing is that you will have small losses if you have tight stop losses, but at the same time 1 or 2 days you will get big trend like what you got today, and even couple of days back also we got a big trend. So during that particular point of time, the chances that you will make good amount of money. Okay, so staying with the system which has worked well for you is always better. So now let us look at the gaps as well as the bar charts for trading. So this is trading view chart, and let us say the activity on Monday, you saw a gap down, you saw a clear gap down on that day, and after that, if you see, it went up, closed the gap, right? So this is the gap, and so the market it went up to that, and once it went up to that, there was some resistance, it pulled it down. But once that particular resistance was broken on an intraday scale, and even today in the morning, there was a good rally. There was a good rally which gave some good profits even on Monday, and had some profits overnight today. So we had a decent amount of profits here. So this is a good thing, that if you have a gap which is closed and market starts to move up higher than the gap, then you can reverse your trade. That is, initially you might have gone short. Here you could have gone short, but probably then this becomes a stop loss as well as a reversal trade. So the gap, if it is closed, it becomes a stop loss and also a reversal trade. Now, how do you look at this particular trade? See, in the very simple ways, so take either a 1 hour or 30 minutes bar chart, 30 minutes bar chart or 1 hour bar chart. Okay, sometimes 1 hour is okay, sometimes 30 minutes is okay. Now let us say there is just wait for the open to happen. Okay, After the open, normally you will see some, if there is a big fall, there will be some pullback. There will always be some pullback that can take place. There will always be some pullback that can always take place. Now let us look at the pullback that is happening, and let's look at that from a 30-minute chart and 1 hour chart, and then we will summarize the trading strategy at the end of the seeing the chart. So here we will go for a 30-minute chart, because you are almost trying to do it on an intraday basis. But if you want, you can carry the trade for the overnight also. Now let's look at this chart. Now here we have, see, there was one, after that there was a fall, okay, then it rallied a little bit, then it went up to this place, okay. Now look at this corrective bar, okay, because on a 30-minute chart you have the market now on a sliding basis, and you have a trend which is on the downside. You have a trend on the downside. Now just look at going short below this, because this is a chart where probably from all trend basis this is a downward, this is on a downward basis, okay. Now you go short on this, but put this 30 minutes bar candle itself as a stop loss. So you have a short which is 16,977 and the stop loss is 17,024, and the stop loss is 17,024, okay. Now say, let us say you would have made a loss which could be 46, 47 rupees. So the first thing is that, no, you look at the chart and look at the overall trend, okay. Look at the overall trend in a 30 minutes time frame. How do you look at the overall time frame? That is higher low, higher close, lower bottom, lower top. So if you have that, then in that case it is a downward trend. So in a 30 minute chart, you look for some corrective action and then sell below a corrective bar, okay, and put that bar as a stop loss, Now we got this stopped out, and it's also a reversal trade. There are two ways for doing it. One is on the breakout itself you can do the trade, or just wait for the correction to happen and go above the corrective bar high, because sometimes you will get a corrective bar, sometimes you may not get a corrective bar, because like today there could be a huge fall, so that we do not know when it will happen. So what you do is, let us say we are going above the high of this thing, so you would have gone long above 17,024 after getting your loss of 45 points, okay. So 17,024 you would have gone long, and on the same day you have on the intraday the close was 17,065 or so, right? So this is the close, which is 17,065. Sorry. So your close which is 17,065. So whatever loss you might have made in the initial part, I think on the intraday you are close, because you are looking for a profit. But if it does not work in your favor, then in that case you are going to cut it off. And so whatever loss that was there, probably on that day the loss has been wiped off. Right? So if you have a gap down, normally what happens is after some correction it will start going down. Now we will see what happened in previous this one. So see, let's look at this. See, here on this day, okay. On this day there was a gap down. Okay, gap down compared to the previous 30 minutes bar, and here the chart is completely down. So wait for some sort of a corrective bar in 30 minutes. So it happened here. Then in that case you go short below this bar or this bar and keep that bar as a stop loss. Now if you see that day it broke down, and probably it went down to some extent, but then it also came back and closed almost at break even for us on that day. So we would not have probably made money in this, but there is a money management strategy. Normally what happens is the first 30 minutes bar will be a very, very good strong, because you've got a very, very high range in a first 15 minutes, 30 minutes or 1 hour. So if you look at the range on that day, it was 17,039 to 17,110, which is 73 points. So it is 73 points. So normally what happens is that already the market has fallen by 73 points. So from there, if it is to fall, probably you don't need to keep too high chance of a profit. So if that bar has been cut, which is the first 30 minutes bar, then the same extent, the same range that you have in that particular bar, put that as a profit target. So here in this particular case, you have got a 70 points, 70 points. So we got 17,039 that is cut. So you have a minus 17,039 minus 60. 16,979. 16,979. You take at least half of your position as profit. Let us say there are two contracts you do. One contract you are taking profit at the 60 point, because that is the stop loss which you have put here. And if you see that on that day, you can see 16,958, and then it started to bounce back. So normally you have that particular range, and after that there is a chance that it will bounce back. And second thing is that normally you don't have a close which is more than the volatility of the market, which we have already highlighted. So you should only get something like on the present volatility scheme of things. Normally there is a 200 points movement on a close to close basis. So extraordinary days only like this, you got a more than 200 points. So because that day was 17,060, today it should have closed at 16,860 or somewhere around 850, even if there is a fall. But it closed at 16,677, so there is an extraordinary day like this. But otherwise, as per the volatility scheme of things, then in that case, it should have stopped normally at almost at the volatility range, which is the previous day is 17,195 or so. So the close should be something like 16,995, 16,995 or so. So we've got a fall which is slightly below that. So we must be careful when it exceeds the volatility of the particular day. So we should be in a position to take the profit on that basis. So what are the calculations that you should look at it? Now let us look at the whether it's a gap down or gap up. Okay, if it is gap down, okay, then wait for some sort of a correction happening in a 30 minutes bar. Okay, then what you do is that you go short below the corrective bar. Go short below the corrective bar. Go short below the corrective bar. Then first 30 minutes, whatever good range that has been built, because normally you'll have a very good range in the first 30 minutes. Whatever range that you get in the first 30 minutes, that should be the extent of your profit for one contract. And the second contract, you can just leave it open to see what happened, like what happened today. So you may get more profit, or even if you're stopped out, you will not end up at a loss. So this is the simple strategy that you can look towards, and in many cases it would have worked. And I will show you another illustration there. Same. See, on this day, okay, this is a gap up. This is a gap up, right? So wait for some corrective action. Wait for some corrective action and go long above this bar. So let us say this particular bar, okay, you have a 17,115. Stop loss is 17,071. Okay, now 43, 44 points. So that's the normal thing as far as the 30 minutes is concerned. Then after that, let us say you could we told you that don't keep more than the volatility range. So the previous day close was 17,030 or so, right? So this particular day we have okay. So this day, the previous day close was 17,037. So we expect that the next day close should not be more than 17,235 or so. So on this day, when you're going long about 17,115, the first profit that you should take is this bar's range. What is this bar range? It is 61 points. So the first 30 minutes has given you something like 61 points. So 61 points above this, 61 points above this can be a top, generally speaking. Okay, so 17,158 plus 61 plus that comes to 17,219. So if you have gone long above this, then in that case, no, even if it starts moving up 17,210, and if you see, that day the close was 17,231, but you would have taken profit at 17,219, and it went up to 17,322 or so. So probably there is a chance that no, you can keep something more than the volatility of the market range. But that's for intraday, it's better not to do that, because there's a lot of chances that after exceeding a particular volatility range, we should be very careful. There can be a pullback. As it happened here. So this is the now let us say next day there's a 30 minutes bar. So next day it opened higher. Okay, then wait for the market to come corrective. Then in that case, you go long about this. And first 30 minutes bar, normally the range should be high. So you have the 349, 299 and 50 bars, and here it's 62. So around 60 points. So normally, you have got something like 45 to 60 points is the range. So 60 points in the opening sessions and all, it seems to be there. So 60 points, if at all it goes above this place, then we should be very careful of more than 60 points from here. So 17,349, if you add then 60 points, normally you will have something like 17,409 or so. But it did not go up to that. Okay, it started to fall. Why it started to fall? See, the previous day was 17,231. Probably there's an expectation up to 200 points could be 17,431. So not normally, every time it doesn't need to go like that, right? So this time it went up to 17,375 and started to fall. So what is a trailing stop loss that you should put in that particular case? What is the trailing stop loss you should put? Now, what we can do is that we can put one particular bar's low itself. Now, since we have got the movement now, it's around 62 points. So since you can keep this 62 points on. Also you can keep moving your stop losses to 62 points from any particular high. Now let's say this particular bar is also not much. See, 62 points, and here 17,376. So 17,376 minus 62, 17,314. So we could have got down at around 17,314. So once it starts to move up on the upside, then you can keep that particular bar's range itself. You can keep moving up your stop losses. So here also, in this particular also, what you can do is that either you can go for a targeted profit or keep moving your trailing stop loss. Now in this case, we have got something like a 45 points. So 45 points from any top, you can keep it for a trailing stop loss. Now here it went up. And see 17,309. So 309 minus 45, 17,265. You can keep a stop loss, and probably you'd have got stopped out, and you'd have had a decent profit. So that is what we are to do. Now let us say in this particular case also, when it started to move up, this is 16,971. So 29 plus 16, 45 points, right? So even if you had been long, so 45 points from any top. Now 17,132 minus 45. Okay, so something like 17,080. Now even if you have been long, you can come out of that particular bar. Now we went short, and today of course this was a pivot break low. So once it started to see, this did not happen in the morning. So here it happened with a gap. See, first of all, today you must understand that there was a gap. Okay, there was opening was a gap. So once that gap started to fill, we should be very careful. So what is the gap? Here is the gap. Here is the close, right? So the close yesterday was 17,064, and it opened at 17,111. So we need to be careful that there was a gap in the morning compared to the 30 minutes bar of the previous close. So once that starts to get filled up, we need to be very careful, because here also we saw that this gap, once it started to get filled up, it started to move up, right? So here it started to move up at the gap. So once it started to close that particular gap, we should be looking even towards a reversal in the trade, like how it happened here. In this case, there is a chance that there could be a reversal in this trade. So we need to be quite careful about the gap closing, and there are many cases here. Of course, it was quite high. Here it was quite high. This was also quite high. Here it was a little low, so it didn't the gap didn't close. And here also, if you see, the gap, the close. So this is a close. So it did not go below that. So the gaps are truly very important for us. And if the gap gets closed, we need to be quite careful about it. So now let us look at this particular day. Same 30 minutes bar. And let's look at this particular day. Now, I told you that please wait for some corrective bar to happen. Now, after a fall, now because the previous day close was 17,400, the open itself was 17,253 and it went down to 17,200. So normally, as I told you, we cannot expect more than 200 points of thing, because that is the volatility range. So the volatility already has taken place in the first 30-minute bar itself. Once that has happened, we need to wait for some corrective action to happen. And once it started to move up, see, it just started to move up, and just go short below any of this particular bar low. And once it started to go below this particular bar low, okay, this particular bar low, then in that case, it was a clear fall. So here, the short was 17,281. Stop loss is 17,315, around 35 points. So you can keep moving your trailing stop losses closer to 34 to 35 points. This one, and then keep moving this around this 40 points or maximum range. We can look at it. So even here, if you look at it, the range was 17,189, 190, and the next bar was 17,229. So 39 points. So 45 points. Normally, you can keep it. Otherwise, you can just keep this particular high as a stop loss. The third alternative for a trailing stop loss. Now, these are all methodologies which you can look at whatever that is comfortable. Now, once you have identified, as I told you, that you go short below a corrective bar. Okay, you go short below a corrective bar. You can keep 3 bars high low or 2 bars low. Some people keep 2 bars, some people keep 3 bars. So if it starts to move above a 2 bars or 3 bars high low, you can use that as a trailing stop loss. What I mean by that is this. See, in this particular case, let us say you went short here. Okay. Now, of course, this itself is a stop loss. Now, let's look at this particular one. Okay. This particular one. Okay. If it started to move up, right? 1, 2, 3. So now either we put a trailing stop loss in terms of monetary limit, or we put the last 3 bars low as a stop loss. So that means 1, 2, and 3. So once it started to cut this particular low, which is 17,016, any trade that we entered in this place, we should be out of the trade. So either you keep 2 bars or you keep 3 bars, whichever is comfortable. But I would prefer to keep a 3 bar high low in a shorter time frame as an important stop loss. So today, now here also, if you look at it, this was the short position. And once the short position, if you look at, you keep 3 bars high. Now this is gone. So you keep this 3 bars high. So it was above this. So whatever short happened here would have got profit taken here, okay, above this bar high. But again, since this is all a corrective bar high, we should again go short below this, because the market, after going a little high, again started to fall. So in the same 30 minutes thing, a trailing stop loss would have got triggered, and again a short position would have been created. That is the beauty of algo. If you go for algo trading, probably what we cannot see, it can easily capture that. So in this particular case, we would have gone short below this particular bar low, and we still be in the market. We are still in the market. So you can use this 30 minutes bar itself to identify also with the help of gap, because normally if it is a gap up, okay, so you just look at the market every day morning. The easiest thing is, okay, whether, let us say it is gap up. Okay, what is the extent of gap? That is, gap up means, I'm not talking about compared to yesterday's high and today's low. I'm not talking about yesterday's close price and today's open price. Okay, so let us say yesterday's close price is something, and then today's open price is this. Then in that case, you can you can wait for a long, you can go long, keeping this particular low as a stop loss. Yesterday's close as a stop loss. Now, where do you execute the trade? Now, if there is a gap is quite huge, the gap is quite huge, then what you should do is you should wait for a correction to happen. You should wait for a correction to happen. Then go long above a corrective bar high. Then go long above a corrective bar high. Okay. Then in that case, on that particular day, whatever the profit target, as I told you, could be a trailing stop loss, which could be whatever the initial stop losses, you keep moving that. Okay. Or you put it last 2 bars or 3 bars low as a stop loss in the case of a gap up. In the case of a gap down, just wait and see whether the market is here, next day there, then let's see the gap. Okay. If it is a very small gap, then wait and see whether it can go up a little bit, come down and all. So once that gap is closed, you can go for a long. Okay. Otherwise, no, go for a short below a corrective bar and keep that low as a stop loss. That is what we showed yesterday. Yesterday was a case where there was a short, the short got closed, and then you went long, made money, and eventually you had a net result which was break even. And today, what happened is that there was a gap up open, and before the corrective bar could happen, the gap got filled. Before the corrective bar could happen, no, the gap got filled. Once the gap is filled, you go for a short, keeping today's high as a stop loss. So that's what happened today. Let us say, if you see in 5 minutes chart, that will be a little more clear. This was yesterday's close. Sorry. So this is yesterday. Yeah. So this is yesterday's close. Today's open is this. So open is 17,111, and yesterday's close was 17,064. So 17,111 went up to 132, then started to come down. So it is better that you close it below this. So if you see this particular bar taking rest at 17,062, the low of 17,062, and this close at 17,064.70. So once it started to cut the 17,064 or 62, you can just definitely go short, keep the 17,132 as a stop loss, and trade the market straight. So this is a very, very simple system, because see, normally loss or profits can keep happening for everybody, but we should try to maximize our profit, let the profit run and cut the losses. That is where probably our ability lies. So this is what probably today 17,162, and we would have been at 16,694. So on some days you get something like 400 rupees profit. So this is the thing. And yesterday was a break-even day, and before that, if you look at it, see, in this particular day, this particular close was not filled up, so you had a profit there. Okay, so it went up, and only when it started to move below this, then the trade got closed. Okay, the trade got closed, so you might have gone long even in a 5 minutes chart. Also, you could have gone long. 30 minutes chart, you did not have had. Now here, if you see 17,285 with a stop loss of 17,217. Okay. So anyway, wait for some correction to happen, and after that correction, you go for a thing with the previous day close as a stop loss in case if there is a gap. Okay, in case if there is a gap, and once the gap gets closed, please ensure that you don't stay in the trade for the intraday. Say for example, on this day, you could have gone long. Okay, keeping somewhere here, keeping this low as a stop loss. Once that is triggered, then you can keep that day's high and then go for a complete short. Okay, and if you had the position running, then you could have kept the position open till this place, and once this place got filled up, trade would have been taken. And today, so every day there is always a gap which happens here, mostly in Nifty. So let's look at what happens as far as Bank Nifty is concerned. See, this may not happen much in commodities, mainly because commodities is a 24 hours market, right? So it may not happen there. So we look at go to the 30 minutes chart. So this is today's thing. Here also it's a gap, and you can see at the close. So this is the yesterday's close. So once that particular close gets filled up, then you can see many times it comes back to that level and gets resisted. So today, if you look at the trade, once it started to go below the close was 36,138, right? So there was 36,138. So once it started to go below that, you can see, it coming 37,150, 160. It just keeps coming, and then not able to get itself anything much above that, and it started to fall. So here, if you look at the gap, so this was also this was so okay. So this is a gap day, and now if you see the gap did not get filled up on the same day, so it went up and closed on this. Okay. Next day there was a gap. Okay, so there was some gap opening, and once it started to go below the close, then there was a fall. But again it started to reverse. So what might have happened is we would have got a short position below this, because we would have definitely gone short below this, and once we are short about this, we will keep this I as a stop loss. So this is the close was 36,045, stop loss is 36,240, 200 points. But on that same day the rally was also there, and if you see it went up to 36,424 or so, which is approximately 200 points. So this is a day where probably would have got into a break-even strategy. So break-even would have happened. So that's why, if you look at the methodology for trading, you can look at either the gap, identify the gap, and go, particularly in the case of Nifty. It works very well for the Nifty. Same time, you can also use, as I told you, that is the Doak theory of going long above a corrective bar once a trend is established. Now let us say in this particular case, so that is the Bank Nifty. So this is a low, right? This is a low, and this is a higher low, because once it started to go above this is a higher low. Okay, so once this is a low is there, and this is a higher low, you can even go above this. You can even go into a long above this. So once you went long above this, you could have gone above this, and see here, this is a high and this is another high, but this is a lower high once it started to break below this low. So whatever you went long about this, you could have gone, taken profit here, and there you could have gone short. And the same thing here, this is the position here, and once you can go long above this, right? So go long about this. So whatever happened here, you could have gone long about this, and whatever long you went about this, you could have got out of the position here. You would have got out of the position here, and you would have gone short. So the higher lows and higher tops can also be used as one important levels of going for the long or short position. And here is another case. You could either, if you have gone short here, or you could have gone short here below this in 30 minutes bar. Here, this is a higher, this is a low, and this is another low. So here you could have gone long above this bar, keep this low as a stop loss. So here, it fell, and so below this bar you could have gone short, keeping this bar as a stop loss. So very clearly, using a very, very simple mechanism, either of gap up, gap down, using that gap filling as one, and second thing, just identify the overall thing. Let us say, because you are trying to do a little more on intraday, so look at 30 minutes, 15 minutes corrective bar to happen, and go long above that particular corrective bar. Now or just wait for one low bottom and another higher bottom, and once the higher bottom happens in the form of that particular bar high being taken off, then in that case you go long, keep that low as a stop loss. Then you trail the stop loss. How do you trail the stop loss? Whatever extent of loss you would have made, that particular thing keep moving. Suppose if the initial loss would have been 45 points, as the market moves up, the high minus 45 points, so keep moving that way. Third alternative, another alternative is that you keep a 2 bar high or 3 bar low. So if it is for an uptrend, keep 3 bar low as a stop loss. If there is a violent reversal, keep a 3 bar low as a stop loss. If you are in a short position, keep a 3 bar high as a stop loss for reversing the short position. So this is what it is. We will do this trading module both for now we try to do for index. We will repeat this on Friday also with the new graphs that will be there with us, and also we look for stocks. We will also look for commodities. But what we are doing that in the case of Nifty and Bank Nifty, we are using a 30-minute chart. We have to see whether that is applicable as far as commodities is concerned. Normally in commodities, gaps will not be there because it's a 24 hours market. So we have to only go with the classic theory of higher lows, higher bottoms, all those things. But there we may have to change the time frame, maybe even to a 1 hour or 4 hours chart, because you have got a 24 hours market, right? So probably we may have to look at a 4-hour chart or 1 hour chart. So please wait till Friday to know about that. So if you have any questions right now, you can please ask now. Thank you. So thanks for your participation. The same thing we will have it on Friday, but using different graphs. Okay, thank you very much. Good night.